Hello everyone. Today we want to discuss few issues associated with fair value accounting for financial instruments. I'm Luis. I'll be discussing first part of the case, which is about the reclassification rules. The rules are there to ensure managers do not abuse their accounting discretion to manipulate the values of the financial instrument through reclassification. So let's say there's a financial crisis. Some of the securities had a sharp fall in their market values. The financial institutions that have those securities on the balance sheet would prefer to report them at historical cost. So how do they do that? They can simply reclassify the assets into the held to maturity category. This allows them to avoid loss recognition, and so this is clearly biased. Once the reclassification rules were relaxed, balance could easily tip in favor of the managers. Management can reclassify assets to boost their income or capital. However, rules that are too rigid could also introduce noise into the accounting data. When market is highly volatile, fair value can be hard to obtain accurately, so fair value may not truly represent what the price of those financial instruments should be. The volatility could also be temporary, in which case the management would be better off to hold and reclassify the financial instrument as held to maturity. Rigid rules deny managers the flexibility to do so in time of need. Therefore, regulators have to be careful when making changes to the rules. I'll pass on the next part to Kevin.
Thank you, Louis. For question 2, I will talk about the incentive for manager to bias the valuation of financial instrument. There are many factors that may impact on management's incentives, such as firm distress, capital market pressures, debt covenants, tax considerations, etc. But only 3 major incentives for managers bias their valuation of financial instruments. First one is the manager compensation or bonus. It is one of the prevalent ways for shareholders to engage in to make sure the manager acts in their best interest. There are different practices across different industries. In the financial industry, performance-based bonuses are the most typical practice. However, those performance-based bonuses are based on accounting figures which influence the manager's decisions and motivate managers to make optimal decisions that benefit their own interest. Such an economic incentives provide a broad field for managers to manipulate the value of financial instruments in order to influence their current and future compensations. Marking to model is a method that management teams make with their own assumption. This method gives managers more flexibility than a marking to market method to control the value of assets in order to optimize their performance. Now I will pass to Roger to introduce more about the rest of 2 major incentives.
Oh, thanks, Kevin. And the second one is consideration of regulatory outcomes. Financial institutions are highly regulated and have to comply with a number of requirements imposed by the central bank. One of the requirements for banks operating in signatory countries of the Basel Agreement is having enough liquid capital resources to protect clients' deposit to ensure that the net assets of the bank can act as a buffer to reduce and absorb fluctuations in the value of assets due to loan defaults or variations in security prices. Such tough measures creates an incentive for bank managers to overstate prices of assets to meet capital requirements, which may get tougher in crisis time. This basically was what was happening with American banks in 2008. When the banks and their managers were trying to cover unpaid mortgage after the bursting of housing bubble to keep their licenses of financial institution. The last one is the stakeholders' consideration. Such incentive takes place when managers want to adjust accounting decisions according to the view of stakeholders. For the bank, the most important stakeholders are account holders. If there is a downward trend in a bank's performance, its stakeholders might think that the bank is losing credibility and might start withdrawing their money, which may end up in situations like global financial crisis, where several banks experienced bank runs. Managers have a strong incentive to manipulate their asset value to show others it is safe to keep their money in this bank and avoid worst scenario. And Kate will talk about risk of allowing financial institutions to report financial security at historical cost.
First of all, I want to say a few words about the power of managerial decisions. Freedom to decide the level of accounting discretion makes management decisions very crucial for future performance of the company, because shareholders, employees, and potential investors will look on companies' financial statements to make their own judgments. That's why the choice of record keeping is so important. The problem that may come up with the recording asset-backed securities at historical cost increases appearance of misleading information in balance sheet and income statement. Keeping record at historical cost will allow managers to have assets records at a higher value, because there is a delay in recognition of a decline in value, especially if such declines are believed to be temporary only. In addition, historical cost record keeping may result in unrealized gains from selling securities. All in all, in either ways, keep or sale, the firm may not be able to reflect a real value of its assets on its financial statements. On behalf of our group, I want to say thank you for your time and attention.